Welcome back to a little bit of chat today, again with Paul Davey, who came back on the show a little while ago to talk about all things Kiwi, but the world's changed a little bit since then. So both of us thought it'd be a good idea to come back and talk about the impact of the latest budget changes on all things New Zealanders looking to buy homes in Australia. So firstly, Paul, welcome back.
G'day. Good to be here.
Wonderful. All right. Well, what are the changes, firstly, that the government's come through in regards to people buying property in Australia, regardless of whether you're Kiwi? And then we can dive into just how this might affect Kiwis and what the New Zealand citizens thinking of buying in Australia should consider.
Okay, well, it's a good question. I hope you've got a couple of hours to listen to my answer. So, what's happened in Australia, it's all been driven solely by government. And it's government, once again, meddling in the housing markets, trying to make it appear more affordable and more attractive to first home buyers. A couple of years ago, introduced what's called the first home guarantee, and there was a 5% deposit scheme. And, that was going along nicely, but then the government interfered, of course, and opened it up to all and sundry, which meant that everybody was now buying a house. Now, what the government has now gone and done is that they've seen house prices continue to escalate, and they've said, okay, fine, we need to try and put a stop to this. So they've implemented a couple of key policy announcements or actually policy directives that have predominantly influenced investors. All right. Mm-hmm. Now, investors in Australia make up 30 to 40% of home purchases, particularly at the lower end of the scale, which is where a lot of those first home buyers tend to sit, right? So the first home buyer kind of market, relatively basic homes. Investors don't buy really expensive houses, they buy the cheap ones to rent out, right? So what's happened here is that the government in Australia has said, okay, negative gearing. New Zealanders will be aware of negative gearing because we used to have it, but it's now gone. But negative gearing in Australia has now basically been removed, for investors, with the exception of buying new houses. But an investor buying an existing home from now on doesn't get the benefit of negative gearing. So that's quite a big thing, all right? Mm-hmm. Basically means that a lot of investors are running, cash flow negative. They don't get a tax advantage to that. So therefore, one of those big advantages for being a property investor has now been removed. Another one is that they've removed the ability for what's called a self-managed super fund to borrow money and buy residential property. All right. So a lot of pension or super fund holders in Australia with decent sized pension funds or super funds take some of it out and manage it themselves, buy residential property, keep that in their portfolio as an investment. What they were doing was borrowing money to buy houses and, of course, stepping on the toes once again of first-home buyers trying to get in. So what's happened here is that the government has implemented predominantly two major pieces of legislation which has stripped out a big demand portion of the property market, particularly in that first-home buyer space.
Got it. Okay, cool. So if we just categorise those changes into two, one of them you just talked about, which was negative gearing, the ability to essentially deduct the interest from inside of your tax. So if you earn $150,000 a year and you got all this tax, you can, I'll assume everyone knows what negative gearing is, but just to call it out, basically you can take some losses on this side and offset them against your income on this side. And they're like, hey, that's not fair on people who don't have those losses, and therefore let's not encourage that behaviour. The other one that's worth calling out is the treatment of the gain on property and how this was treated and how this will be treated now. So let's just talk about this other pillar, this capital gains tax treatment for investment properties, what changed there as well. And then we can start to talk about, for a New Zealander who's coming in to buy, what this may or may not mean for them and play that out.
Yeah, cool. Yeah, so the capital gains tax thing, once again, it's another, I suppose it's been a benefit to investors in the past where they've received, or in Australia, yes, you do get charged capital gains tax, all right? But as an investor, you typically got a concession, some degree of relief from the capital gains tax that you would pay on a property when you eventually sold it. Another one of the pieces of legislation passed has been effectively an increase in the capital gains tax on investors when they do eventually sell a property. Right.
Yeah.
There's also been other capital gains tax, related elements as well with respect to inheritance and stuff like that. But the main thrust is capital gains tax on investors has effectively been increased, which means that investors buying residential property, they've lost a whole bunch of benefits, right? Which has really impacted on that space. So what it really means, for a New Zealander coming across, if you're looking to buy an owner-occupied property, not an investment property, you're going to live in it, all right? You don't expect to get a revenue stream from it. You're not buying it for an investment purpose. You're buying it to live it, all right? You need somewhere to live. So those tax changes themselves don't directly influence those buyers. All right. The only real influence that they may see or probably will see is that if they go to an auction room or if they go into a negotiation situation to buy a property, it means that they don't have the investor or the self-managed super fund guy also in the room trying to bid up that property. Right? It means that you've taken out a big chunk of the demand for those particularly the first home buyer sort of segment of the market. Yeah. Basically, it means that the buyers, or particularly owner-occupied buyers for first homes in particular, they're just going to get a better opportunity. They're going to have the opportunity to be buying the property without a bunch of cashed up dudes behind them bidding the property out from behind them and walking out the auction room with nothing. All right. So impacts investors in particular. All right. Doesn't directly impact owner occupiers. All right. But will it have an impact on property prices? Look, the answer is probably yes. Yeah, I certainly think so. I think over the last few years you've seen a significant uplift in property prices, right across Australia. Some markets in particular have done better than others. Brisbane and Perth, for example, have benefited obviously from small self-managed super funds and investors coming into the market and really bidding up the prices of those properties. With that demand now gone, it just means that the market will adopt more of a balanced kind of feel to it. The sellers aren't in control. And so buyers are going to have a better opportunity to actually get a fair deal.
Yeah, and I mean, it's armchair political commentary to go, is that a good thing or a bad thing? Yeah, I think we're gonna go into that a little bit because I think it warrants at least having a position and a point of view on it, which is, in my opinion, there's two ways to think about this. In the short, ultimately, houses need to be more affordable, which means that the price of houses either need to come down or salaries relative to the price of houses needs to improve. And either of those things means that people will feel like there's less wealth in their house compared to their income. And that means that people who otherwise couldn't afford houses can afford houses in the short to medium term. And what we're seeing in the data already, both the auction data and the home open data, and even starting to show up in the price data, as of recent totality data, for example, is that houses in a whole bunch of markets, Sydney and Melbourne, but even in those hotspots you mentioned, Brisbane and Perth, especially at that kind of sub $1 million range, are becoming less traffic. There's less people at the home opens, less offers being put in, and quote unquote more affordable. Where owners are like, I'm not getting the price I expected, and buyers are like, well, this is what I'm prepared to offer. So, you need to think about where you stand, and that feels like a good thing. In my opinion, I think that is a necessary thing, and in a lot of respects, what the policy is designed to do. However, the policy itself is grandfathered, meaning that anyone who already owns an investment property continues to get the benefit that they get, both on the CGT side and on the negative gearing side, is my understanding. And the rest of it doesn't come in. Realistically, the CGT stuff doesn't kick in until the middle of 2027, and only for these new properties, and only assuming they're existing properties. So we haven't really had time to see the longer term impacts of the policy in the market. We don't know whether this will result in a stabilisation of house prices or maybe even a reduction of house prices relative to wages. And that's the bit that's still yet to play out. So firstly, two questions. One, just your thoughts on that short-term impact versus long-term impact. Not saying you're an economist or you're, Brandon, not having an opinion beyond what you think. And I'm not an economist either, but we're close to the market. And then secondly, if you have that viewpoint, how does that impact a New Zealander who's thinking, hey, I'm here now, I need to live somewhere. I want to buy a place. Like, what should I be doing now? Or should I not be doing something now? Should I be sitting back and like, what are your thoughts on that?
Fortunately, I do have a degree in economics, so it was kind of handy. Yeah, look, the short-term thing, yes, look, some of these initiatives or legislations are not going to be fully enacted for some time, 2027, etc. But if you are a news hound, or even if you've got an ear to the ground, you'll realise that the media is beating this thing up big time. Right? You see headline after headline of, oh my God, we're in a property crisis, prices are crashing, auction rooms are empty, blah, blah, blah. The media are absolutely gobbling this up. So I wouldn't be surprised if somehow some of these big media outlets were leaned on by government to say, hey, can you do our job for us and tell everybody that the property market is in dire straits? As a consequence, yes. Are we going to effectively sort of jawbone the market down? All right. Now you can run that alongside the rhetoric that's also coming out of the Reserve Bank of Australia as well. All right. So the Reserve Bank of Australia, once again, I use the term jawboning, which basically means that they talk a big game, but do they finally enact upon what they're talking about? And the answer is, yeah, they're talking a big game. Hey, beware, we are going to be increasing interest rates. Well, they're not going to, because the economy is already in the poo, right? And the last thing they want to do is absolutely sink the Australian economy, all right, by putting interest rates up again. They've put them up enough, warning the market, hey, watch your spending, otherwise we'll put them up again. All right, it's a classic move from a Reserve Bank is to do that sort of thing. It's basically telling everybody, watch out. And so, so look, with the media, the government and the Reserve Bank all acting together, what they're effectively doing is trying to, number one, stop house prices from running away. All right, because that's what they've been doing the last couple of years. Let's face it, they've been on a runaway bloody freight train. It's been crazy. Right? And that had to stop. All right, so basically what they've done, they've all got into the cockpit of the train and all yanked on the brake. All right? They said, look, enough. This is enough. We need to stop this. Okay, so that there is the short term, but the short term obviously ultimately leads to the long term. The long term being, well, what happens in the long term is almost irrelevant because it's already happened in the short term. Right. So I'll go back to the media. Right, it's really only been the last couple of months that we've actually seen, some evidence coming through that the property market has slowed down, if not even going backwards in some places. Sydney, Melbourne, for example. All right, but according to the media, it's been going on for 6 months, 12 months, but it hasn't. All right, the media is really giving us a big old kick in the pants. All right, so like short term, yes, we are definitely seeing that, and like I said, most of it's just been driven by what we're being told as opposed to what we're actually experiencing. Right. With respect to Kiwis, coming over to possibly looking to be buying a property here, there'll be a lot of Kiwis that'll look at it from the New Zealand experience. They'll go, look, 2020, 2021, 2022, we had a property market that was just going mental, all right, because we had COVID, obviously. Reserve Bank reduced rates to virtually zero. Money was free. They're throwing money away, all right? As a consequence, property prices went on a big old escalation, along with everything else. So, and then what happened after that is that we had to get real, right? And all of a sudden, property prices in New Zealand stopped going up and then started going seriously backwards. All right, that's still ongoing. I imagine there's a bunch of New Zealanders out there that are thinking to themselves, "Is the same thing going to happen in Australia?" And look, it's a fair concern, primarily because New Zealand's a test case. Is Australia making the same mistakes? Arguably, they are. The government's stepping in, is trying to bash things down. The media's beating things up. The Reserve Bank is increasing interest rates to try and effectively engineer a recession. So you kind of think, oh, hang on, this is a mirror image of what kind of went on back in New Zealand. So, look, it begs the question, you come over here, look, you got to live somewhere. If you've owned a house in New Zealand, or if you currently still own a house in New Zealand, but particularly if you have owned a house in New Zealand, you've sold it, you brought your money over here. Look, you were in the property market, all right? And the best thing to do, certainly in my opinion, is that don't leave the property market, all right? Once you're in, you've got to stay in. If you don't stay in, you'll be bitten in the ass, right? You will not survive, because what'll happen is that you go, I'm going to wait until property prices, bottom, and then I'm going to buy at the bottom. But nobody picks the bottom, right?
Yeah.
I mean,
and what even is the bottom?
Exactly. The only time there's a bottom in the property market is when it's on its way back up again, all right? And by then you've gone, oh, God damn it, I missed the bottom. And now...
Love that guy.
So look, you're never going to pick the bottom of the market, all right? And, the best thing to do is, number one, if you're coming over here, you want to buy a house, don't rush into it. Take your time, all right? It has become more of a balanced market. Beforehand, particularly hotspots like Brisbane and Perth, southeast Queensland, people were rushing in, and they're just buying whatever they could, all right? You don't have to do that now. You can take a more of a balanced approach. And, if you bide your time and you do your homework, you talk to the right people, get yourself prepared, then, look, you'll buy a house and you'll buy it well, right? And then, look, if the price dipped by 5% over the next year or two, what does it matter? It doesn't matter.
What does it matter?
Yeah, you're living in it. You got to live somewhere. You either pay your mortgage and just continue to live and enjoy your existence in that house, or you pay some exorbitant amount of rent, which just goes pouring down the drain. All right. So look, I think it's representing an opportunity for Kiwis to say, you know what, I'm not pressured to buy a house. I can actually take my time and do it on a considered basis, which I think is indicative of a fair, balanced market, which is much better for everybody.
Yeah, and I might kind of wrap all that up nicely. So we've got changes that happen in the budget, a whole bunch of fear-mongering that happen around those changes. Those changes are aimed not predominantly, entirely at investors, and their intent, like it or dislike it, is to try to take investors out of the market in probably the short term and even over the longer term. We can debate what will happen at a macro level in the long term, but in the short term, what that appears to be doing is taking some of the heat out of the market, because it is removing a portion of buyers from the market, either somewhat or altogether, because those advantages for that group, that cohort, if you like, investors and self-managed super fund investors as well, those advantages are being taken away. But those advantages were never relevant to our owner-occupier. Our owner-occupier has never been able to deduct interest or have any kind of negative year-end claim, and doesn't pay capital gains on a property if they go on and sell it anyway. So from a practical perspective, if you're a Kiwi who's coming into Australia, two things really apply. Firstly, the changes at a direct level don't apply to you at all, assuming you're looking to buy a place to live. Great, that's change number one. And then change number two is that because those changes only apply to investors and the result has been a pretty immediate departure of that investment class, at least for now, especially over properties that already exist, not necessarily new properties, it means that as a New Zealander coming into the market, you have the opportunity to be more thoughtful and more considered. You should always be thoughtful and considered when you're buying a property, but now you're not in this fight or flight FOMO situation where, like, oh my God, what's going to happen? And yes, if there's a concern that, oh, well, what might happen at a macro level if I buy a place for $750,000 now, and we see prices drop by 20%, the question you have to ask is, over what timeline and how does that impact you? If it's ultimately where you're living anyway, and your net result ultimately is driving this thing and your timeline is 10, 15, 20 years, then even a 10% drop in a short-term market probably doesn't affect you. That's like you're thinking over the wrong timeline. Have I kind of wrapped that up pretty well?
Yeah, you have. And look, a really important thing to realise or consider, particularly with owner-occupied property, is that if your house falls in value by 10%, so has every other property.
Right.
So you say, well, okay, I could have bought the $1 million house, but I bought $750,000 house. Right. My house has fallen by $75,000. theoretically. But the $1 million house has fallen by $100,000.
Right.
So technically, you could say, actually, this is going to be more beneficial for me because I can end up eventually trading out of my smaller house and buying a bigger one for a relatively lower price. Right? So look, it's not all terrible, because remember, your home, your owner occupied property, is effectively a currency, right? Once you've got a house, that's what people do. People just swap houses, right?
Right.
And they just put a number on it, right?
Yeah.
So it's important to realise that, don't get wound up about that. Oh my God, the property market could fall further. I could lose money, but you're not losing money, all right? Your capital, your equity is still residing in that property, and you can use that capital and equity to trade into another property at some stage in the future. All right. So don't let that be a major consideration with respect to buying a house, because let's face it, you all have to live somewhere, and rental properties are expensive and difficult to find. So
and
bite the bullet.
And I'd probably kind of add to that in 2 points. One being, if you're living in the place and not leaving the place, the fact that the market has done something is kind of irrelevant. And then
exactly. Yeah.
And then the second point is that, and this is true in any market, but especially true in this market, I think, is you never want to be a forced seller. If there is a concern that property prices might dip inside the next 1 or 2 years, make sure when you do buy the property that you buy it knowing that not only the bank will lend you the money, but that you can afford it. Even if you see a slight change in your situation, like I'm out of work for 3 months, can I still buy it? I have a big unexpected bill like I have at the moment, which is driving me bananas. Can I still afford, don't need to go into the detail of that, but can I still afford to maintain the payments on this property? The last thing you ever want to be in any situation that involves, large sums of money is a forced seller. That means that you might have to sell it and crystallize a quote unquote loss. I have one more question relating to kind of the New Zealand Australian thing, because this is going to be super relevant to people who are maybe in the Kiwi side on the fence at the moment, and are coming across soon, and are looking at relative exchange rates and how those have moved or are moving, and what these changes might be doing to those exchange rates. Have you got any intel or insight on that, especially with your broker hat and your economist hat on?
Yeah, so the Kiwi-Aussie cross is an interesting little beastie. We've over the last couple of years, we've gone from, say, 95, down to 82. Right? So, a couple of years ago, you could buy 95 Australian cents. Now you can buy 82. So that's a big change, right?
Massive.
However, you look at the trajectory or the way that that's moved in the last couple of months. We've been bouncing along that sort of 82 sort of level for Aussie Kiwi, and looking at the long-term charts, looking at where we're relative to the 200-day moving average, getting all technical here, but we're looking like a very sort of almost oversold in terms of Kiwi versus Aussie. In my opinion, we've hit the bottom. Right, we're not going to dip materially below 82 simply because well, number one, the interest rate differentials. We look at New Zealand interest rates are about to go up, right? Australian interest rates, we should be at the top of the cycle, all right? As a consequence of that, you'll start to see that the interest rate differential start to squeeze up. That'll favour New Zealand dollars, all right? The Australian economy is, let's face it, the Reserve Bank has engineered a recession.
Definitely not wading into that territory, but sure.
Well, they have. Right? And
I think they're one of many parties who are contributing to where we're at financially and productivity-wise.
So look, Australia's going to struggle a little bit over the next year or two. As a consequence, the currency will suffer. So look, Kiwi dollars are cheap at the moment relative to Australian dollars. I think it will get better. So the issue is, look, if you have to bring money across, don't let the currency dictate. Don't say, oh my God, I'm losing money. Well, you're not. You just have to suck up the exchange rate. That's just the way that it is.
Yeah. So I guess my point was the so what there for someone is if you're wanting to move now and you're ready to move now, you have an amazing work offer, or there's some family motivation, or it's time, or you've sold your place and it makes no sense to try to straddle the difference. Don't let the short-term fluctuations in currency dictate the longer-term strategy. You got to see the bigger picture, but also by the same token, if you're 6, 12 months out of a strategy, be mindful of what the currency rates are doing, where they're at now, and where that may head based on some, well understood macroeconomic factors like the New Zealand economy, the Australian economy, without having to be an economist. And maybe part of the so what here is, trying to kind of bring it full circle. Wherever you are in this process, the best thing to do is to have people in your pocket, in your side of the fence, to help you navigate this stuff and understand this stuff and know what to do and when to do it as best is available based on the data that we've got.
Yeah, absolutely. And if you're a Kiwi, you think, I'd like to move to Australia at some stage in the next 6, 12, 18 months, and a great way to make that decision is to reach out to people, to discuss, what do I do? What's going to be my best option, particularly from a financial perspective. You're reaching out to the likes of, a good Kiwi broker that operates in Australia. And I happen to know one. I can put you in contact with one. And so you reach out, you have a chat, you say, okay, cool. What are the best options here? What do you think? You can have the discussion about it. You might not agree, you might totally agree, who knows? But at least you're having the discussion and you're making an informed decision. That's the most important thing.
Yeah, and I'd say the way I would sort of sum that up is that there's a Venn diagram that says here's the nature of the Australian market, and if you're thinking about moving here and buying property here as a result of that, then there's the reality of the Australian market, and then there's the overlay of the reality of the Australian market and the opportunities for a New Zealand citizen. And some of that's relevant to the budget changes that have just come in, and some of it's relevant to all the things that you have to know that are available, because Kiwis are treated very differently to essentially the rest of the world when it comes to how lenders look at them and treat them, from grants and exemptions and stamp duties. It's a different beast to anyone who's coming from any other country because of the relationship between Australia and New Zealand. And so there's very few people that I would know, and you're the only one I know actually, who sit in both parts of that Venn diagram. And so the conversation you want to be having is with someone who understands the Australian market and understands it in the context of a New Zealand coming into the Australian market.
Yeah. Exactly.
Excellent. Anything else for our listeners and viewers today? Well, I was going to say there's a third part of the Venn diagram, which is also a Kiwi, but I'm assuming that's relevant too. But
yeah. Well, just as a final sort of sign off, I've got friends and family sitting back in New Zealand in the South Island freezing their asses off, and I'm sitting here at the Sunshine Coast in a t-shirt because it's 24 degrees.
By the way, we have cold places in Australia too. So I'm sure you could choose both, although I'm obviously not as well versed. Beauty. All right, Paul, that's a wrap for today. That's very insightful. Hopefully anyone who's listening to this got the drill. And if you are a Kiwi in any part of the process and you want to get an opinion or even a second opinion, Paul's your man, and reach out to me. All these details will be on the thing. So thanks again for joining us today.
You're welcome. Just call me. Thanks. Bye.